Hello, my name is Simon Pickard and I'm the chairman of UBP's Impact Investment Committee, and it's my very great pleasure to be here today with Kanini Mutooni. Kanini is one of three independent members of our Impact Advisory Board, and I'm here with her today to discuss impact investing in public and private equity markets in the current environment. Kanini, it's an absolute pleasure to be here with you today.
Thank you so much, Simon. Really pleased to be here. Thank you.
That's great. I wanted to start with, you've spent many years working in impact investing. Obviously, for most investors, I think they're all very familiar with the notion of ESG, but perhaps a little bit less familiar with impact investing. Could you give us your view on how we should think about the differences between ESG and impact?
Sure, Simon. I think this is a really important question. And I think as impact investors and as members of this investing ecosystem, we really need to be careful about the terms that we use because, it's not helping our case if we keep using terms interchangeably and people don't understand what we're trying to refer to. So I will give an overview of the differences between those two terms, but I will also bring in an additional term that's used interchangeably in our ecosystem, and that is SRI investing. So that's socially responsible investing. So if I start off with SRI, now SRI, social responsible investing, focuses on what we call the negative screening process in public markets. And what that means is that as a public markets investor, we have specific values that we believe in and that we adhere to. Some of those values could be the fact that we don't want to invest in tobacco stocks or pornography stocks or even fossil fuels. So what we do in that instance is that we take these values and we ensure that those values are almost, if you like, integrated into the process of selecting public market stocks. And what happens is that the negative screen will remove any of those stocks that we feel in any sense violate our values. So that is really what SRI investing is, using a negative screen to ensure that we're not doing any harm in the selected stocks that we invest in. When we come to ESG, so that your specific question, so just to clarify, ESG stands for environmental, social, and governance priorities or practices. This goes a further step to where SRI left off. ESG focuses on an in-depth analysis of a company. And what we're doing there is asking ourselves the question, as far as this company is concerned, how are they treating the environment as far as their work and their operations are concerned? What are they looking at in terms of carbon footprint? What are they doing in terms of water usage, recycling, the circular economy, and so on? So the E is really focusing on the company's take on its environment. When you look at the S in ESG, we're looking at the more social factors. And in this current environment with the racial injustice protests, gender diversity, the S has become really meaningful in how we select our specific companies to invest in. So S would be looking at how a company manages its gender diversity, how it deals with social inclusion, how it deals with racial justice, etc. And this could be policies, it could be practices, it could be views as well. When you look at the G, this is where governance comes in. And governance is mainly related to how the board works, how effective the board is, and how the interaction between the board and the management team works. Is there a very dominant CEO? Is there a split between the board chair and the company CEO? And does the governance actually work in this organization? So that really is ESG, sort of taking a step further from SRI and really looking at all those three factors as far as a public market stock is concerned.
So that's great. So ESG is, if you like, an internal operational measure
Exactly. And when you think about impact investing almost takes a third step in terms of, depth and detail. It's way beyond SRI, it's way beyond ESG. And with impact investing, the questions that we're asking this time round are, as far as this company is concerned, in terms of the generation of its specific services, the products it's producing, if you like, how is the company focusing on creating an overall positive change in society? And this is usually a little bit difficult to determine, Simon. It needs quite clear intentionality from the perspective of the investor and the company itself. So, for example, if you're looking at a company that is producing solar panels, in one instance, if you were going to ask yourself the questions around impact, you would be asking yourself, how is the production of solar panels going to help in terms of, for example, reducing use of fossil fuels or promoting clean energy? And what's the impact of doing exactly that? So it's really two things, Simon. There needs to be an intentionality and there needs to be a measurement of that impact that's being generated by the company. And without intentionality, and I think this is a really important point, we cannot really talk about impact. We can't imagine that impact can come as a nice to have or an addition without intentionality. Then that is really not an impact strategy.
Kanini, that's great. Thank you so much for your answer. I think that's really, really clear. Thank you. Second question. Kanini, I wanted to ask you, your main area of focus is really impact in private equity, which was the birthplace of impact investing, if you like. Now that impact is becoming more widespread in public equities, what different or perhaps similar roles do you see the private and public markets playing in addressing the Sustainable Development Goals?
So, Simon, I think this is a really important question as well. My experience has largely been in the private market space. Over the last 10 to 15 years, my focus has been mainly emerging markets and private markets. But what we're starting to see now is that we really cannot ignore public markets. If you just look at the sheer size of them in comparison to the private markets, we're looking at an average size, if you look at the equities market, of about $85 trillion globally. That's the size of the public equities market. If you look at the bond markets, we're looking at over $100 trillion. So the size, the mere size of these markets means that when you're thinking about the SDGs, we really cannot ignore their role in helping fund the gap. And what does the gap look like right now? It's between $5 to $7 trillion. And it keeps getting bigger, especially post-COVID. I think we all are aware of the fact that, governments are struggling to manage the health crisis. Spending is going down. There is going to be a much less of a focus on filling that, funding gap of 5 to 7 trillion. So where do public markets sit in this conundrum of fulfilling the SDGs? Now, in my mind, I think the advantage of public markets is that they bring what I would call a tried and tested transaction mechanism. You can trade them. They're not illiquid. They're part and parcel of our economy. So, to a large extent, we need to make sure that we use them for what they are. If we are going to use public markets to fulfill this bridging gap of $5 to $7 trillion, in my mind, the first thing that we need to do as investors, as wealth owners, or as asset managers, is we really need to be more articulate in how we describe our investment thesis when it comes to exposure to the SDGs. Now, Simon, I've seen some really interesting decks and write-ups from fund managers where you have a very pretty chart on the SDGs on one page. But when you look at the investment thesis in terms of how the SDGs are going to be integrated into the investment decision-making process, there is no alignment. So I think that's a real gap and that's a weakness that we in this sector specifically in the public markets, need to fill. We need to articulate very, very clearly what our investment thesis is and how that relates to the SDGs. We shouldn't just have exposure to the SDGs as a tagline. It should really be integrated into our investment processes and in how we construct our portfolios. Now, I think the difficulty here, Simon, and we need to accept that there is a difficulty, is that the SDGs need about 20 to 30 years to come anywhere near completion. But when you look at the time horizon in public markets, it's much shorter. So there's obviously a gap there in terms of how long we will need for the SDGs to be achieved and how long on average we would hold a public stock as an investor. So I think there's a role there for fund managers to educate wealth owners and educate investors around longevity and the patience that's required when it comes to helping fund the SDGs, and just looking forward and thinking that 5 years will not do it. Likely much more than that is going to be required to reach any form of progress on the SDGs.
I think that's very, very, very well. We've seen very well there. I think the differences between the private equity world and the public equity world.
Precisely, and maybe, Simon, it might help to talk about the experiences that I have had in terms of being able to see the lessons that have been taken from the private side that could be used in the public side. I think this is a great segue to talk about that.
I think that's right. And I mean, specifically, I think that public equity impact investors, how do they think about, for example, their own contribution? Whether that be engaging, whether it be in being long-term, measuring their impact. I think that's something where the private equity world probably has some very useful lessons and tips, if you like, for the public equity world.
Absolutely agree, Simon. And I think that for me was one of the reasons why I spent so much time in the private market, specifically private equity and venture capital, is that, this whole notion of value creation we're relentless about that. How are we going to add value to the company that we are investing in? And this starts right from the due diligence process. Right from due diligence, we're asking ourselves the question, how are we going to help this company increase its productivity, grow its team, really integrate its strategy into a growth and scale-up strategy that makes sense? And also, from a cost and profitability standpoint, how are we going to help this company grow and develop? Now, that relentless focus on value creation, when you pull that into the public markets, it becomes a little bit more difficult, but it is not impossible. So the way we see it is that from a public market standpoint, what fund managers and investors need to do is really come up with a structured portfolio engagement model. So really enabling us to use our voices as investors to push for change in the organizations that we invest in. Not being, I suppose, what we would call passive investors who put money on a stock and sit back and wait to extract profit. That is not the way impact is going to be created. So, I've seen best practices in the public market sector where, we come up with a really clear portfolio engagement model that is evidenced with follow-up, with questions to management, with really specific areas of focus to ensure that we create real value in the company that we're supporting. Now, I think it's also important to state that for this to be effective in the public markets, just thinking about the time horizon point that you raised as well, is that private markets do come with an inbuilt, baked-in advantage that we hold a company for maybe 5 to 10 years. So there's a long period to really be able to build that value. But obviously in the public markets, that becomes a little bit more difficult. And we do have to keep that in mind, that the time horizon does reduce the amount of time that we have to make a change. I think we need to accept that right from the outset. But having said that, I think there's still room and there's still a possibility to help a company grow and really help it create value during the short time that we hold the investment stock as public investors. Now, just one additional thing I'd like to add, Simon, just in terms of what I think public markets could learn from the private side is this area of innovation. And this is, again, one of the reasons why I've really loved investing in specifically in venture capital, is that, we can actually use our capital, even in public markets, to promote innovation and to invest in sectors that maybe are not that well known or that were not considered investable before, to really create impact and create change in the world. I mean, one example is, low-income housing, trying to reduce the level of homelessness that we have even in developed markets, or health, trying to come up with innovations that will prevent the next pandemic from happening. Now, I really think there's a role there for public markets to start thinking about deploying capital to those little known areas that might require a little bit more risk taking that private markets have been doing for a very long time. I think that's just something to add in there in terms of the outlook and the fact that we might need a mindset change in public markets as well.
Yes, I think that's right. I think that public markets tend perhaps to be a little bit conventional compared to private markets. And I think that impact investing, if there's one thing that impact investing is not, I think it's conventional. So thank you very much for that answer. Kanini, I'd love to turn to the COVID pandemic. I don't think we could be recording this in June of 2020 without talking about COVID. And specifically, it does strike me there's been a great deal of comment in the last few months that this crisis may well hinder investments into achieving the SDGs, simply because companies and governments are going to be concentrating on recovery, and that therefore commitments to saving the planet and to helping the world's poor, etc., may just be put on the back burner. What's your view from the areas of impact that you've been looking at recently? Do you share that fear?
I mean, Simon, I'll be honest, I did share that fear right in the beginning. My thought process was that, oh my goodness, the amount and the level of impact capital being deployed is going to decrease significantly, simply because of fear, uncertainty, and, just sort of, holding back and waiting to see what happens, which is what investors typically do. But I have been pleasantly surprised in terms of how impact investors as a whole have reacted from a capital deployment perspective since COVID hit. And I'll explain why I am saying that. During times of recession, Simon, I think this is the time for the most innovation. I think this is when we can really take the opportunity to take a step back and look at things differently. If you think about the Great Depression, we had the most amazing inventions that came out of it. We had Scotch tape was invented during the Great Depression. We had the fluorescent light bulb. We had Fortune magazine being launched. So, I see times of economic depression and even social unrest as being a fantastic time for innovation and change. And to be honest, this is where impact capital has really come in terms of playing a part in funding early innovations, specifically in the health space, that have been coming out during this really, really unprecedented time. So just to clarify that, obviously we know that there were clear vulnerabilities in our society even before COVID hit, but I think post-COVID, these vulnerabilities have really been thrown up in our faces. Issues around, health access by minorities. We've seen issues around health systems and the poor state a lot of them are in, not just in developing markets, but in developed markets as well. So as a result, what we're seeing from an impact standpoint is investors are now using their patient capital, which, as we said before, comes with risk, comes with a much longer time horizon, and they are putting it towards mainly health. I would say I've seen a lot more capital deployment towards health towards vaccines, towards propping up public health systems. I've seen that happen with both public and private sources of capital, and areas that touch on education, so flexible provision of education and the future of work. And as a parent myself, I mean, I have really experienced what it feels like to be a teacher of 3 young children during this 3-month period. So, I see a lot of innovation coming out from there, and the role of impact capital in really helping fund these innovations at an early stage to ensure that, that real impact and change is created in the world.
Thank you very much, Kanini. That's quite a hopeful answer. And I must say, I sort of share that hope in that I certainly feel that over the last 3 months, I've lived kind of a decade in terms of new experiences and things that I've seen around me. And I think that is quite a hopeful thing. So thank you very much for sort of sharing that.
Absolutely. I mean, we have to be optimists, Simon, as parents. We have to remain optimistic. That's my sense.
One thing that perhaps is, perhaps less optimistic, and I'd be really interested in your view, because I know that you spend a lot of time investing and looking at emerging markets. It's clear that this crisis is going to widen the gap between the emerging and the developing world, particularly just because the emerging world doesn't have the resources to fulfill the social sustainable development goals. Does this change at all the priorities that you think that impact investors should have?
I think that's a great question. Simon, if you look at where emerging markets are right now, I think the last report that I saw about a few days ago was that about $90 billion had been pulled out from emerging markets in Q1 at the end of Q1 2020, $90 billion. So obviously investors are really, fearful and uncertain about where emerging markets are going to go. And, that's proven by, the level of capital flight. I think the other thing is, from an economic growth standpoint, emerging markets are not looking good either. I think China is going to see its lowest growth level in over 44 years. Sub-Saharan Africa is going to grow by about, I think it's minus 1.8%. Latin America is going to see a contraction of about 5%. So all the numbers look terrible, and it's just good to acknowledge that. But, having said that, I think what we're seeing happening is that even if these economies have, structural deficiencies, which, to be honest, were there before as well, I think what we're starting to see now is a move towards what I call blended capital. So combining private sector capital with government capital or public capital, and putting them together in order to create vehicles of change to fund social services or areas that are going to be significantly hurt due to COVID. And that comes again to health, public health systems, improving access to telemedicine, improving access to vaccines, because I think that's another area that has really struggled during COVID. A huge number of children have gone unvaccinated because of the fact that, everything's been shut down. So I still see the possibility of new innovations coming through in terms of how capital is used, in terms of working directly with governments to create vehicles that will help fund social services that just cannot be funded at the moment. And again, it goes back to my point on innovation, Simon. These are times where even in emerging markets, I'm starting to see huge amounts of new products that are coming through that would never have come through if it wasn't for COVID. I have seen, to be honest, in the last month, quite a number of decks, fundraising decks on the private side of, new, I would say, products that will help do things differently going forward, mainly around education, mainly around working from home, and mainly around measuring the productivity of your team when you're working remotely. So again, I remain an optimist that even though emerging markets look really dire, we're still going to see some positive moves on how capital is blended and on how innovations will be structured going forward.
That's great, Kanini. Thank you. And I think that's right. I mean, there are opportunities for impact investors to help emerging markets in this current situation, and really to benefit from some of the innovation that you've talked about. So thank you very much for that sort of description. I thought I might close, Kanini, on a sort of question on the next generation, and I think it's it's pertinent for both of us. We both have children. I know mine are a bit closer to working and investing age than yours are, but nevertheless, this is something I think that we're all thinking about in terms of parents. I've noticed that my children look at the world very differently to the way that I looked at the world when I was their age. Do you think that our children and the next generation are going to demand that their savings are invested in a different, more impactful way than the way that we've traditionally looked at the world?
We're already seeing that change, Simon. If you look at the way millennials look at money, it looks completely different to yours and my generation in terms of how we looked at money. Millennials, as the last report that I saw in terms of how they look at deploying their capital, Toniic issued a report that saw almost 70% saying that they would like to deploy their capital in line with the SDGs. 70% of the ones that were surveyed. Now, for me, that's huge change. And for me, that shows a very different perspective from the one you and I had, during our time. And that's great news in the sense that you and I talk about impact investing as being this new thing, this very trendy thing that people were all trying to understand. But I see that generation as having already, drunk the Kool-Aid, if you like. There will be a much less difficult generation in terms of understanding why capital needs to be deployed for both social and for profit purposes. I think it's going to be a much easier argument. They're already there. And even for children, the age of my children, I think there's already a thought process around, we need to help others. We need to make sure that we're not just thinking about ourselves, and we need to make sure that we're thinking about the world and conserving the planet for their own children. I think just giving you a quick sort of story about my own children, I mean, this last 3 months has really opened their eyes to, for example, the issue of inequality. They have seen, the differences in terms of, looking at the level of education they've been able to have at home with online learning compared to others who've not even had access to the internet or to a tablet during the last 3 months. I mean, they've been able to see that and live that themselves. So when you look at that, almost, I would say, clash of cultures, you start to see the fact that our children will really and truly see things very differently when it comes to them being able to have access to wealth and deploy it. I think they'll do a much better job than we have.
Kanini, that is a wonderful way, I think, to end our conversation on a sort of very optimistic note that what we consider as being something incredibly original, impact investing, will just be second nature to the next generation. I mean, that obviously will I think be a bigger driver of change than anything that we could probably think of. So as I say, that's a really optimistic way to end. And thank you so much. It's been an absolute pleasure to speak to you today. And I wish you the best for the summer and for the rest of this period and seeing light at the other end. So Kanini Mutooni, thank you very, very much.
Thank you so much, Simon. Really enjoyed talking to you today.
Thank you. Goodbye.